Let's do some math. Did you know the average American will spend 90,000 hours working in their lifetime? Now, assuming they work for 40 years and assuming they earn the average hourly salary of $11.22, they'll make around $1,009,800 in their life. And of that $1 million, they will pay $340,343 in taxes to the government. That is nearly half the money they make in their entire life. This is Jeff Bezos, the founder of Amazon. He made $67.4 billion in 2020. And he paid $0 in taxes. Now, hearing that might make you angry. How can someone who made so much money not pay their fair share? You might be thinking, he must be hiding his money, or maybe paying off some politician, or maybe even the simple fact that the rules clearly don't apply to him, and he must be doing something illegal. Now, what if I told you that this is in fact 100% legal, and the only difference between Jeff Bezos and you is that he understands how the rules work? In this video, I'm going to break down how the wealthy avoid paying taxes and how the tax system works in the United States. First, we're going to take a look at the history of taxes in the US, where they came from and how they work today. Then we're going to discuss how the top 1% make money, because before we can talk about taxes, we need to talk about income. Then finally, we're going to reveal the secret that the rich use to avoid paying taxes. If you're interested in more videos on financial freedom and in-depth breakdowns of the world of finance, subscribe to my channel. I also have a newsletter that, if you're here, I think you'll love. Within it, I share actionable finance advice and tools that I'd actually want to receive with over 80,000 freedom seekers. You can find that in the link in the description, but for now, it's time to go down the rabbit hole. Part 1. How the tax system works in the United States. When looking back in history, one thing is true when it comes to money. There has always been a small percentage of humans who have the majority of it, and the rest of us have had to work for it, scraping by a living. Whether it was kings and queens, wealthy robber barons, or eccentric tech tycoons. The truth is that 1% of the population has always owned 99% of the wealth in the world, and 1/10 of that 1% has almost all of it. But this is not a video about the inequalities of life and the distribution of wealth. This is a video about taxes, so we need to start here. Now, the first record of organized taxation dates back to ancient Egypt in around 3000 BC, and is even mentioned in the Bible in the book of Genesis, stating that the pharaoh would send soldiers to collect 1/5 of all grain harvested as tax. No matter what civilization you look at in history, there has always been some version of tax. And culturally speaking, it has not always had a good rep. Think about it. In many of the movies that you see, taxes have been perceived as something that is imposed on the poor from the wealthy overlords. In fact, one of the main reasons the United States became an independent country was sparked by taxes on tea imposed by the British government in 1776. You might remember that lesson from history class, taxation without representation. At the time, it was more about the fact that American colonists had had no say in the political decisions that governed them rather than the nominal fee on tea. But fast forward to today, taxes are perceived very differently and have become somewhat of a politically charged concept where one half of people see it as a civic duty to pay for roads, schools, playgrounds, while the other half see it as something that is still imposed on the general population by the elite class of politicians who govern us. The reality is, there's probably somewhere in the middle that is actually true. Which leads me to the question, when did the tax system develop in the United States? How does it work today? And how is it that some of the richest people in the world, like Jeff Bezos and Elon Musk, are able to avoid paying taxes altogether? In the early years of the US, the federal government made most of its revenue from things called tariffs. These were taxes on the goods imported to the country. So every time a good was shipped to the United States to sell, there was a tax on the goods. This worked fairly smoothly for a while, but that was until the country's economy started to grow and the Industrial Revolution began. During this time, the United States started to export more goods and import less, which made tariffs less useful. Then the Civil War happened, which prompted the first American income tax in 1861 to help fund that war. At first, Congress placed a flat 3% tax on all incomes over $800, and later modified this principle to include a graduated tax. Then, in 1862, Congress passed the Internal Revenue Act and created the Bureau of Internal Revenue, which is the IRS as we know it today. Fast forward to 1913. A change to the 16th Amendment was made, stating that the Congress shall have the power to lay and collect taxes on incomes from whatever source derived, without apportionment, among the several states, and without regard to any census or enumeration. In other words, the income tax was established and here to stay. When first established, the tax was only intended to affect the rich, taxing a 2% fee to anyone who made over $4,000, which at the time was only 1% of the population. Over the following years, tax brackets were introduced and modified to what is currently used today, a progressive income tax schedule. This allowed for the ability to not only tax the wealthy, but the middle class as well. In this system, each bracket of your income is taxed at a different rate. The more money you make, the higher percentage is owed on that specific bracket. Now, this is where things get interesting and leads us to our next chapter, how the wealthy use the system to avoid paying taxes. Chapter 2, not all income is treated the same. Don't hate the player, hate the game. Here's an interesting fact. In the United States, not all income is treated the same. In order to explain this, we're going to use the cash flow quadrant developed by Robert Kiyosaki. In this chart, there are 4 types of income. First is employment income. This is also referred to as earned income and is income that you make from a job. This is the income that you get from a paycheck or a salary. The interesting thing is, this is the same for both blue-collar and white-collar jobs. Whether you're the cashier or the CFO of Apple, your salary is taxed as earned income. Earned income is the most common type of income, but it is also the highest taxed income. This is the money that is taken directly out of your pay in the form of withholdings. In other words, every time you get a paycheck, there's a portion of the money that you are paid that is taken out for taxes. So next on the quadrant is self-employment income. This is similar to earned income, but the only difference is instead of having a job, you own your job. These are people like massage therapists, photographers, and people who don't work for a company, but make money providing a service. The benefit to this type of income is that you're able to lower your taxes by declaring expenses. For example, if you're a photographer, you can write off the gas you pay to get to your photo gig. You can write off the cost of your camera. You can even write off part of your rent as an expense. Now, the downside to self-employment income is that self-employed individuals are required to pay an additional self-employment tax of 15.3% on top of federal and state income tax. They're also required to manage their taxes themselves or hired an accountant to do so. This leads me to business income. This is the income that is generated from a business. Similar to self-employed income, it's calculated after expenses. So for example, if a business makes, say, $100,000 in a year, but it spends $60,000, it actually only gets taxed on the remaining $40K. And that's a big difference because if that $100K was earned income, then you would be paying tax on the entire $100K versus just the remaining business income of $40K. So right away, just from owning a business and creating business income, you're able to dramatically lower your taxable income. This is the first step into where the wealthy avoid paying taxes, and it starts with business deductions. The interesting thing about business deductions is that if you're a business owner, you technically can claim deductions on things that you use in your everyday life, as long as you can prove that it is something that you use in your business. So, for example, the Michelin star steak dinner can be deducted as a business meeting. The $300,000 G-Wagon that you purchased for your wife's Valentine's Day gift can be entirely deducted as it could be considered equipment and used to travel to and from the office. You can even deduct the salary of an accountant you pay to find more deductions. The final section is investment income, and this is where most of the magic happens. Investment income is the income that is made from investing in assets such as real estate and stocks. In other words, this is the money that you make from money that you have. Investment income is the playground for the rich, and this is where money is converted into wealth. This is also one of the main ways the wealthy are able to avoid taxes. For example, let's say that you were to earn $400,000 this year. If that was earned income, you would be taxed 39.6% on that money by the federal government. However, if you were to earn $400,000 on a stock you invested in, and you were able to sell that stock after a year, you would only pay 20% on that income. This is called long-term capital gains tax, and it is significantly less than the tax placed on earned income. But this is only step 1. The rabbit hole goes deeper. Buy, borrow, die. The one thing that is often misunderstood is that millionaires and billionaires of the world do not necessarily have millions of dollars sitting around in a bank account. In fact, I was recently at a Grant Cardone seminar, and he says that as soon as he earns income, he spends it on assets right away to avoid that very situation. Instead of cash in a bank account, they own assets that are worth millions or billions of dollars. These are things like commercial real estate and shares of a company in the form of stocks. For example, Jeff Bezos has the majority of his wealth in the form of Amazon stock, which as of July 2021 is worth around $199 billion. The interesting thing is, he doesn't owe any money in taxes until he sells the stock, and it's taxed as a capital gains tax. So even though Jeff Bezos is worth hundreds of billions of dollars, he's technically not taxed on any of it. On top of that, when you look at his salary as the CEO of Amazon, he pays himself just a little over $80,000 a year. So you might ask yourself, how is it that someone who is supposedly worth billions of dollars, but is at the same time not able to spend any of that money, still able to buy a super yacht, fly around in private jets, and go on a Sunday cruise in a $3 million Bugatti? Well, for one, some of those things can be bought and paid for by his business, as we mentioned previously. But there's also another trick that the rich can employ to avoid paying taxes that is called interest rate arbitrage. When you own billions of dollars of stock, or even just millions of dollars of stock, you are able to borrow money from banks against your stock, which, as you might have guessed, is not taxed. Then you have the ability to live off that loan and pay the interest rate, which is much lower than if you were to sell your stock and pay capital gains. However, you can also employ this thing called interest rate arbitrage, which is when you're able to make money from the money you borrow. Let me explain. Let's say that you borrow $100,000 from a bank, and that loan has a 2% interest rate, meaning that you have to pay the bank $2,000 to borrow that money. But let's say you invest that money in something that would give you a return of 10%. Meaning you would make $10,000 from that $100,000 that you borrowed and invested. You would then pay the bank back $100,000 of the loan plus $2,000 interest. But you would then get to keep the $8,000 profit you made from investing the loan. This is another way the rich are able to get richer. And if you scale that $100,000 to millions of dollars, you can see how that can turn into a lot of money. There is also one more loophole that the rich employ. They die. You see, when Elon Musk's Tesla stock goes up in value, he doesn't have to pay tax on any of that stock unless, of course, he sells it, of which he would then need to pay capital gains tax on the profit of the stock, which is the value of the stock minus the original investment. However, when Elon Musk dies and passes his investments over to his children, they would only have to pay capital gains taxes on the increase in value after they inherit the asset. This is how the richest families in the world are able to build and keep wealth. They buy assets, they borrow money against those assets to make more money, and once they die, they pass their assets onto their children who continue to build that wealth. Buy, borrow, die. So if you're still here, I imagine you might be wondering, what does this mean for me? I'm not the founder of a rocket ship company or a Fortune 500 company. Well, it turns out that you don't have to be, and you can still use this information to your advantage. Now, this leads me to my learnings, and it's something that I wish I would have set up when I first started working in my early 20s, and that is learning how to start a business. Now, this is something I didn't actually know was possible, because in my head back then, I thought that in order to have a business, I needed to have an actual store, the products, the employees, and all the things that we associate with a big company or a brand. It turns out this isn't true. In fact, all you need for a business is to establish an LLC in America and have a product or a service to sell. That's it. Now, to show you how this works, let me use an early job I had as an example. When I was studying finance in college, a job I took was in a popular Australian bank that I actually got through an agency. They placed me in the role, the bank paid them, and the agency then paid me as an employee. It was a part-time role so I could study, and the pay was around $5K a month. I remember the first month waiting to get my paycheck for $5K, and I was gonna buy all these things. I was gonna buy a laptop and a camera, and life was gonna be good. So I thought. That was until payday rolled around, and my first paycheck came in for $4,110. Little did I know the government needed to take their cut, and it came in the form of withholding tax. After paying for my rent, paying off my student loan, paying for gas and food, I was left with about $1,000. No laptop, no camera. Looking back, this is what I would have done. I would have approached the HR person at the bank and said that I would accept the role. But instead of agreeing to an employee position, I would have asked that they pay me as a contractor in the form of service fee instead of a salary. This would have actually saved them money, as they were paying the agency a premium on top of my wage just for placing me in that role. I would have then also set up a company of my own and accepted that money into the company as a consulting fee instead of directly into my personal bank account as an employee. Now, this was in Australia at the time, but the same foundational rules hold true, that businesses can deduct expenses and get taxed on what's left in most places in the world. Now that I would have had a business, I could have turned that earned income into business income. This would have allowed me to write off many of the things that I spent my money on as expenses and began to lower my taxable income. For example, every time I went out to lunch, it could have been a business meeting, The laptop I eventually purchased could have been written off as a business expense. The gas in my car could have been written off as a transportation expense. And I had to travel to doctors' offices and get them to sign loan documents. So even the car itself that I purchased that year could have been written off as a business expense. Now, a caveat here. You can't just buy anything and say that it's a business expense, but you can look at the rules on your tax office's website and pretty easily find out what's appropriate. Or you can follow me on Instagram as I post some little-known tax deductions there. Now, when I first learned this, it kind of blew my mind, because this is not something I ever learned in school, and I was studying finance. However, it is something that has drastically changed my financial journey and that I wish I would have known earlier. There are, in fact, a lot of different ways that you can legally save money on taxes, and that rabbit hole goes deep. There are even tax specialists who I've personally hired, and you can hire too, to manage people's money to lower their taxable income, and they get paid really well to do so because of the amount of money they're able to help business owners save, like Elon Musk and Jeff Bezos. And if you're like I was, you might assume that none of this stuff really matters and it only really applies to the ultra wealthy or massive companies, but it's just not true. You can greatly benefit from knowing this stuff and applying it to your life, even if you're just getting started in your career, making much less, I'm sure, than Jeff Bezos and Elon Musk, which, newsflash, everyone is. Even if you only save a few $1,000s a year, that money could be invested into the stock market or used to buy a rental property. And it's actually that process that truly allows people to build wealth. You turn earned income into business income by starting a business. Then with the remaining business income, you invest into assets like stocks and real estate, which in turn gives you investment income. This is the holy grail because this is passive income. The type of income that is made in your sleep or while you're vacationing on your yacht in Ibiza or doing whatever it is that you want to do. And if there's something I've learned the older I've gotten, it's that success looks different for everyone. And it's not so much about the number in your bank account, but having the freedom to choose how you spend your time every day. That's what understanding finance allows you to do. I hope this video was helpful for you. If you found it valuable, I would love for you to subscribe to the channel. I share videos here every week. And also don't forget to subscribe to my newsletter so I can send you all the tools that you'll actually need to start applying this stuff in your own life. See you soon.